Sylvia. Tell them how you feel, girls. Work your blondie, Ramsey your heart like Liberace. Find your freedom in the music. Find your Jesus, find your Cupid. You will never fall apart, Diana. You're still in our hearts. Never let you fall apart. Together we'll dance in the dark. Baby loves to dance in the dark. 'Cause when he's looking, she falls apart. Baby loves to dance in the dark. Baby loves to dance in the dark. 'Cause when he's looking, she falls apart.
you found me feeling like I'm home. Wish you would remember April to September, wanting to be near me, waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lie back in my own dream, play back on a big screen, you and me together.
Yearly trial of subscription of Prime as well.
Dan, also got to kind of look at the year in review here of the new head over at Amazon, Andy Jassy, who has been in the job for almost a full year. What, 2 weeks, 3 weeks out from now will be a full year. So what's kind of the review thus far?
Yeah, I mean, look, it's still TBD almost, because the way that this kind of unfolded for Jassy, really he was kind of doomed from the start for this year at least, right? If you look at some of the numbers, they had to expand their workforce dramatically. The stock is down 37% year to date. That's because they had hit a $6 billion headwind in Q1. They're expecting a $4 billion headwind in Q2. That's supply chain issues. That's the war in Ukraine. That's inflation. Obviously, they're talking about they added some fees for the rising gas prices. Let me just look at how much they expanded over the past 2 years. In Q1 2020, for instance, they had net sales of $75 billion. In 2020, in 2021, that exploded to $109 billion. And then obviously, we're going into 2022 right now. We're expected to see increased sales, but the cost of doing business has risen. They expanded their workforce by at least half, about double the size. That includes fulfillment centers in 24 months. Absolutely wild numbers there. And so, in Q1 alone, they had seen a loss per share of $7.56. That really hammered the stock big time. And so, year to date, as I said, it's down 37%. But you got to wonder how they're going to try to pull this back. There's been talk, obviously, of hiring slowdowns. That's the main thing, because they have too many workers. There's also talk of them trying to sublet some of their warehouses, because that expansion was to cover the pandemic era. And now that people are going back into brick and mortar stores, they're not buying online as much because they just simply don't have to. And look, after 2 years being stuck inside, I don't have a problem walking to the mall, going through shops. I'd rather do that almost at times than shop on Amazon, though I still do use Amazon frequently. And I think a lot of people are trying to find that balance now. Amazon's got to find that balance when it comes to the expenses that it has.
All right, Yahoo Finance's own Tech DH, Dan Howley, stepping in at bat. All right, guys, that's going to do it for us this hour. However, we've got much more coverage here as the markets have entered mixed territory on the comments of Jay Powell. We've got much more at the top of the 11 a.m. hour.
What should the future deliver? Program
Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. We've got a lot to dive into beyond just that song that you heard, plus more that are on Brian Sazi's Friday playlist here. Let's start with a look at the markets here, because things have taken a leg lower, and acceleratingly so for the Dow and the S&P 500. Both of those in the red right now. The Dow down 194 points, about 0.7% there, and then the S&P 500, you're seeing that in negative territory to the tune of about 20 points or 0.5%. The Nasdaq holding on to some gains as of right now.
Look, Brad, this is the type of action we're going to see for folks who have not traded through rate hike cycles from the Fed. This is what we're going to get. Head fakes usually at the open, and then you get some commentary, as we did from Jerome Powell, that they're acutely focused on inflation, and you see the markets turn lower.
That's right. We're going to keep a close eye on what has been a rough week for investors, to say the least, for sure.
Indeed it has. Let's start there. It has been a rough week for investors, to say the very least. The Nasdaq has now lost a third of its value after peaking back in November. The S&P 500 could notch its worst week since March 2020. Individual stock performance has been even more jarring. Let's look at some big names. Coinbase down 13% on the week. Robinhood down 22%. And then I would argue the benchmark indicator here, Apple down 5% over the past week. And Brad, this is the sell-off is starting to, I would say, accelerate, but also remind a lot of folks out there, this is the market action you should expect ahead of rate hikes from the Fed.
Yeah, there is a report to Congress that the Fed and Fed Chair Jerome Powell actually put some language within there. Unconditional is the word that the markets are latching onto, an unconditional approach to really combating inflation here. And that certainly has triggered the move that we've seen on the day here. And particularly, it raises a lot of the questions that came up on the conference call, or came up on the press conference, rather, after the Fed decision that was so heavily awaited and even leaked ahead of time on the basis point rate hike as well, on the 75 basis points that we saw come through on Wednesday at the conclusion of their two-day meeting. But even more so, this question of recession, how deep it could be, when it could take place or show up in the data, because people are already, quite frankly, feeling it right now. Yeah, and you have to wonder, what is that next data point that could potentially take this market lower? Is it the next jobs report? Is it the next read on consumer spending? We spent the past over 2 hours talking to various economists and market minds, and just listening to their tone, you don't get the sense that any of this is priced in the market. And you look at the valuation on the S&P 500, a little over 16 times forward earnings. I get it that it's down from about 20 times or 21 times at this point last year, but still not at that screaming buy level yet. Yeah, Beth Ann Bovino saying that it might not be as significant as markets fear, and that on the recession front. And then even yesterday, going back to Veronica Willis, who we spoke to from Wells Fargo, she said that we're expecting a mild and short recession. The bigger question for the markets, though, is what type of bear market that we've already entered into will this be? Is it a small bear, a little baby bear? Is it a grizzly bear type of equation? And what does that mean for the rotation for a lot of investors out there too? Well, we're about to find out. Yeah. We're only a couple weeks away from earnings season, and it's going to kick off with the big banks. And you could hear some, I would say, a 1-2 punch from these banks. And by that I mean warnings on these conference calls from banks, but also in the card spending data that they in fact come out there and produce. It could be two major red flags to watch. That's right. Well, we're going to continue this discussion. Let's bring in our next guest. Joining us now for more on the market conversation, we've got Royce Investment Partners Co-Chief Investment Officer Francis Gannon. And Francis, want to get your perspective on everything that we've heard from the Fed this week, including more commentary that's moving markets today. Yeah, it's been as you said, it's been a very interesting week. And in our world, in small caps, the past 7 trading days, the Russell 2000 is off about 14%. So a lot of damage has been inflicted on the market. Francis, where do you hide? Where can you go? Is there any place to hide? Well, I mean, in a week where the S&P 500 entered a bear market officially, small caps entered that bear market in January of this year. And we are down about 32% from our peak last November. The average stock in the Russell 2000 through last night is off about 48%. So I think at this particular point in time, you have to start looking out about 3 years to the opportunity set that's being created in the market today. Look, bear markets are not fun, but the good thing about bear markets is they don't last. And our job is to take advantage of those particular dislocations. So I think one of the best places to hide in an environment like this is actually small caps. If you go back and look
at the data, since 1930, the small cap asset class is the only asset class that has actually outperformed inflation in every decade. And I think that's something in an environment where people are so uncertain about so many things, I think we have to kind of use history as our guide.
Well, 3 years is a long time. When you try to, if you're an average investor out there, you're down 40 or 50% on your holdings today. What do you do? If you own a portfolio of well-capitalized companies with good balance sheets, do you buy more of those stocks, or do you sell those names and just raise cash?
So in my opinion, in this particular moment in time, with so much damage being inflicted in the market already, if you can find high quality companies within the small cap asset class, this is a time to actually high grade your portfolio to add to those particular names. You've been living in a market for a period of time that is so focused on kind of those top end in terms of market cap, and that's unwinding, and we're seeing that. And then for all intents and purposes, those stocks, I think, could actually be the ATM of the market for a period of time, where other markets can benefit, and small caps are clearly going to be one of those areas. What I think people are missing in some of the themes that are happening, be it reshoring or the end of kind of what we've seen, the expansion outside the United States. As companies come back to the United States, there are many small cap companies in the United States are going to be benefiting from increased manufacturing activity here in the United States. So almost think of the kind of the middle of the country as being that new kind of emerging market. And those are areas I think people should be focusing on, industrial areas that are really going to be benefiting from a lot of the reshoring that's taking place.
Francis, what's to say that small caps wouldn't be even more adversely impacted by any signs of or an indeed oncoming recession, considering their balance sheets are not typically as strong as some of the larger cap players, or at least on a revenue basis, and some of the margin basis there as well is up for discussion too?
Well, I think that's one of the great myths about small caps, and I think people miss that. Yes, 43% of the index doesn't have any earnings at the end of the first quarter of this year. So a big swath of companies don't even make any money. But I think when you actually spend time, as we do as active managers in the small cap space, what you find there are great businesses that have very solid balance sheets. And you can actually sleep at night owning these fantastic business with solid balance sheets. And I'd say we're big fans of operating leverage, not financial leverage in the companies that we own. So you can find great balance sheet companies in this particular environment. And kind of to put the correction that we've seen this bear market into, kind of to frame it a little bit, which I think is important, we're down 32% from our highs of last November. The Russell 2000, in the history of the Russell 2000, there have been 12 corrections of greater than 20%. And this is one of those, obviously. But as we were going into the COVID correction, around the economy completely shutting down during COVID, the correction in the Russell 2000 was 41.8%. Today, we're in an economy that is slowing clearly, but we're not necessarily in a recession as of yet, and we're down about 32%. So I think it's a different time. Every bear market is different, but I think you have to look out to find the opportunities right now.
How do you find or unearth some of these small cap opportunities, Francis? What type of screens have you been running of late?
We tend to focus, as we have for a long time in terms of our business, on these better businesses within the small cap space. We call them, serial compounders, if you will. And so we look for companies that have very high return on invested capital. We look for companies that generate, actually not only have earnings, but generate a lot of free cash flow and have the ability to return that free cash flow to shareholders. And so in looking at businesses like we have for a long period of time, we unearth these wonderful businesses and can hold on to them for 3 to 5 years. And that's kind of our goal as an active manager in this environment. We've lived in an environment where zero interest rate policies, those long duration assets have clearly benefited from valuation wise, at least from what has happened. And now I think as that pivots away from those, long duration assets, you're going to see within the small cap space, I think real businesses, and it's kind of strange that you have to say this, but real businesses with real cash flow, with real earnings, that is where the market is really going to gravitate.
Okay, so which sector within small caps particularly are you focusing on there?
Yeah, sure. Mentioned a couple here. One is industrials. I think industrials is a wonderful place to find opportunities over the next several years. Today, I would focus on information technology. And when I talk about information technology, I don't mean the sexy part of information technology. Focus on the kind of the very simple parts of tech that in our world are really important from a B2B standpoint. It means many of these products are built into other products that the world needs. And in that respect, you see constant cash flow and revenue and demand, which I think is really interesting. Other area of the market that we find interesting in this particular moment in time would be financials. Some of the financial markets obviously have gotten hit quite hard, but financials is such a big area. It doesn't necessarily have to be the banks. It can be insurance companies, and there's an interesting insurance cycle taking place today. So I think there is opportunity if you have the ability to do your work in the area right now for the next several years. And when we look at it from a valuation perspective, EV to EBIT, which is kind of our favorite way of looking at it, we're selling at a significant discount to what the Russell 2000, the market is selling at a significant discount to what it's been now over the past several years.
Royce Investment Partners Co-Chief Investment Officer Francis Gannon. Good to see you. Have a good weekend. Coming up, we have a market debut this week, folks. Consumer products company Grove is going public. We're back with the CEO next. Grove getting into the groove of the markets. The consumer packaged goods company, which owns brands including Miss Myers, Burt's Bees, and Tom's Toothpaste, made its public debut today through a SPAC merger backed by Sir Richard Branson's Virgin Group. Here to talk about the company's debut, Stu Landesberg, Grove Collaborative co-founder and CEO. Good to see you. Good to see you out there on the market, Stu. Look, it's a challenging time for the markets, for the economy. How close did you get to just not coming public?
So for us, our mission is to change our category, the home and personal care category, to be a positive force for human health and particularly to have a material positive impact on our category from a sustainability perspective. And that is a long-term mission. And it's also inevitable. And so we look with a long term about our public offering and particularly going public in partnership with Richard and the Virgin Group as an opportunity to cement our leadership position as the brand that can take our category in this, our category, this $180 billion category in the US, and transform it to be better for people and especially planet.
Does this mean we're going to see Grove products in some of the Virgin hotels?
I sure hope so. I'll say we're working on it.
Okay, a follow-up to that, of course, we've seen other de-SPACs, as Brian was mentioning a moment ago, cite uncertain market conditions. And so with regard to today and the liquidity moment for the company, You know, what does this mean in terms of advancing and investing into the operations of the business?
So we look at the long-term goal as how do we bring our products, which are the most sustainable, the most efficacious, available at a really attractive price point, and candidly are beautiful to as many customers as possible. So looking forward, we've built a $300 million plus business in the direct-to-consumer channel, but we're seeing 100+% growth in retail. We launched in Target last year. That's been extraordinarily successful, and we expect to see explosive growth as we add points of distribution over the coming years and bring the Grove Co. brand of products especially to millions more consumers every single year who are making better choices for their homes and for the planet.
Stu, you mentioned Target as a key customer. They were out recently warning about the state of their business, high levels of inventory throughout the stores. Have they taken a more cautious approach to inventory?
I can't speak to Target's overall approach, but what I can say is that we've seen a terrific commitment from Target to build a more sustainable assortment to help their guests make choices that are better for the environment without compromise, which is why I think our platform of sustainability, efficacy, and affordability is so important. And we've been lucky to be able to expand our points of distribution with them over 100% year over year. And we're doing that because our product performs with every customer, and it performs in a great economy, and we've seen it continue to perform well even in a more challenging economy today.
Customers in this economy as well, though, have been prone to trade down on some other products. And so to what extent are you monitoring the rate at which customers are trading down into, and especially in the categories that you operate within?
So we always look closely at the data. And of course, we operate a direct-to-consumer platform with millions of customers. And so we see an extraordinarily fine grain of data. And what we're seeing right now is that our brand has real resonance and real strength with our consumers because our brand is so strong, because our product innovation, like our 1 ounce concentrate, our cleaning products, we sell a 1 ounce concentrate, which you can put in a reusable glass vessel, totally different from everything else in the market. And so we've been lucky to see a really resilient consumer and a really strong brand that's had really great loyalty. And so I know overall the category is struggling, but we're lucky to play in a space where brand loyalty is extraordinarily strong. And we offer a product, hand, dish, bath tissue, good economy or bad, people are still doing their dishes. So we're really lucky to have a strong brand in a consumer staples category in a market like this one.
Stu, I'm on the investor relations page on your site, and the last presentation that I see is looking for about $514 million in sales for next year. Should we slip into recession, can you still hit that?
So if you look at our projections over the long term, and I think if you look at our most recent guidance, we've done a good job of this. The market right now is asking companies to get profitable quickly, but our long-term goal is to be a double-digit above industry average grower, which is consistent with the trends in natural and e-commerce in our space over the last several years. And I think what you can expect from us is to drive gross margin really hard, drive EBITDA margin really hard, and get the business more quickly than we previously thought possible to a place where we're generating positive free cash flow and are growing at double digits above industry year after year after year.
Timeline, when do you expect to achieve profitability?
We've said we'll be profitable in 2024, and I feel like we have a lot of the levers in our control to make that happen. I feel more optimistic about that path to profitability today, even given the market environment, than I ever have in the past. And again, that goes back to the loyal customer base, the strong brand in extremely durable categories, and the innovation I know we have rolling down the pipe, which I hope creates upside for us.
This year, Stu, how much of an inflation headwind are you seeing in your business?
So we've always had really good pricing power. We haven't said anything publicly about whether or not we'll take prices, but historically we've had success when we do. And on the supply chain side, because we're so committed to quality, the vast majority of our supply chain is in the US. So we've seen some cost inflation, but we've been able to avoid passing much on to the consumer at all, and we've been able to maintain strong margins. And we expect both of those things to continue to be true. So we've fared, I think, certainly some impact, but we've fared quite well on a relative basis in terms of supply chain impact.
Stu Landsberg, who is the Grove Collaborative co-founder and CEO. Congratulations to you and the company on this milestone occasion. We'll have to check in the future. Thanks.
Looking forward to it. Thanks again.
You got it. All right, guys, everyone, let's take a quick look at the markets here as we are just a little bit over 90 minutes into trade, actually closer to 110 minutes into trade. Quick math there works out. All right, this market check is sponsored by Flex Shares. Dow Jones Industrial Average, you're seeing that back in the green. Don't call it a comeback, because it's not fully.
I won't.
Come back. The Dow Jones Industrial Average right now is up, though, by about 0.1%, 39 points in the green. S&P 500, you're seeing that up, 11 points there, 0.3% in positive territory. And the tech-heavy NASDAQ, you're seeing that sitting higher, triple-digit gains as of right now, 131 points higher on the day, 1.2%. Coming up, everyone, Inflation Nation. As prices rise, some states are taking it a lot worse than others, where consumers are losing the most confidence ahead. Welcome back to Yahoo Finance Live, everyone. Inflation crushing consumer confidence nationwide. A recent survey by Morning Consult, it shows which states are losing consumer confidence in the midst of rising costs. Yahoo Finance's Danny Romero joins us with the latest breakdown. Danny?
Yeah, Brad, Americans are in search of relief as consumer prices really hit that 40-year record high. We just saw last week that the U.S. consumer confidence tumbled to a fresh 11-year low, reflecting really the concerns around inflation. Now, by a state-by-state level, according to the Morning Consult's index, consumer confidence fell in 48 of the 50 states, the most since August of 2021, and the average ICS deterioration rate was 5.1%, the sharpest decline since April of 2020, right around when the economy shut down. Now on the other hand, now let's look at the states. Alaska, North Dakota, and Montana saw the biggest drop in consumer confidence. Now, on the other hand, Nevada and New Mexico really saw the improvement when it came in the month of May, with their ICS numbers rising to 1.8% and 0.4%. And that could have been attributed to the fact that travel and tourism sector, they're really recovering from the pandemic. Now, according to this survey by Morning Consult, they saw the sharpest really decline in the in July of 2020 when it came to consumer confidence. And that was all due to the coronavirus cases really starting to surge up once again. And then from there, we were hit by supply chain issues that really caused an increase in prices. And then this year, we were hit by the variant in the beginning of the year. And then in May, the big focus around consumer confidence still remains around inflation. So that's really when, we started to see the consumer confidence start to tumble. Guys?
And Danny, what about the global outlook?
Yeah, the U.S. consumer confidence, is falling really further behind from Mexico and Brazil. Now, one advantage that Mexico is really resilient comparison to us is that due to their gas and fuel subsidies, which is really helping consumers from rising energy costs. But however, if the U.S. falls into a recession, it will be difficult for Mexico to avoid it due to the fact to the close trade and economic ties between the two countries. Guys?
Danny Romero, thanks so much. Coming up, Yahoo Finance senior columnist Rick Newman will join with his latest Bionomics hot take. Don't go anywhere. President Biden has had a lot to say about the state of the U.S. economy, but one thing he has been relatively quiet on, stocks. Yahoo Finance senior columnist Rick Newman joins us for This Week in Bidenomics. And Rick, no tweets from the president on stocks.
No tweets, no nothing. He really has nothing to say about the stock market. He's been talking a lot about the economy. He clearly is trying to send a message to voters. He knows inflation is too high. He knows gas prices are too high. He feels everybody's pain. But he has not expressed really any sympathy at all for stock market investors. And if you go back to his, look at what he said about the stock market during his entire presidency, about 18 months so far. He really has never said anything about the stock market. He mentioned it one time last September, And he said, you'll notice I've never said a word about the stock market. Then he said a word about the stock market. He pointed out it was up 17% since he had taken office. Of course, it has turned around lately with both the S&P and the NASDAQ in a bear market. So the White House has been getting questions about this. Is President Biden aware of what's happening in the stock market? What does he think? And basically, the spokespeople have said he's aware of what's happening in the stock market, but he doesn't consider the stock market to represent the overall economy. And I found one clue to his thinking in this interview he gave to the Associated Press yesterday. He talked about the Trump administration, and he said one of his frustrations about the Trump administration was that, and this is a quote, everything was constructed and built and arranged in order for the top 1 to 3% of the population to do very well. Everything else seemed to be an afterthought. So that suggests Biden doesn't want to express a lot of sympathy for investors losing money in the stock market because he considers them to be wealthy people, and he wants to focus more on lower income and middle class people.
I guess the natural thought would be we have to consider and take into account here the number of new investors that have entered into the stock markets over the past year and change, whether that be because of the meme stock frenzy, whether that be because of some of the stock splits, making big companies, household names, Tesla, Apple, Google even, more accessible to some of those investors, even as we're waiting for some of these new stock splits to still take effect. Should the White House have a more concerted strategy around this from this point forward?
So you're talking about speculators, I think, more than what you might call long-term investors. And you could also toss crypto investors or crypto speculators into that group. They're obviously taking a beating as well. But I think even more broadly than that, Brad, I mean, like half of Americans own stocks, and most of them are not speculating. Most of that is retirement savings. That's 401k plans. And it starts to seem a little mysterious that Biden doesn't acknowledge that people's nest eggs, their retirement accounts, are actually losing value. A lot of people who have retirement accounts also own a home, and that asset is actually doing very well. That is appreciated by a lot. But in terms of the wealth effect, people, do look at their investment accounts and their retirement accounts, and no one likes to see, negative numbers in your retirement account. So I think that is probably contributing to this gloom and some of these terrible confidence numbers that we're hearing about. So I think it would make sense for Biden to address this at some point.
Yahoo Finance's own Rick Newman joining us now to break down everything, or joining us to break down everything Bidenomics. Rick, we appreciate the time here.
Bye, guys.
See ya. All right, guys, coming up, we've got more of a tech dive here. The latest feature that users are not that excited about here as Instagram goes full screen. Stay tuned.
More controversial news for Elon Musk. SpaceX has reportedly fired several employees who took part in a letter that was critical of both the billionaire and the space company. Yahoo Finance tech editor Dan Halley joins us with more. Dan.
That's right, Brian. This is a report from the New York Times saying that an unknown number of employees were released from SpaceX as a result of this letter that was written, basically criticizing CEO Elon Musk and his recent public behavior on Twitter in particular, as well as that report from Insider saying that there were allegations of sexual harassment related to a former flight attendant on a former SpaceX flight attendant in which Elon Musk apparently paid $250,000 to after those harassment allegations. And so they were basically trying to get the employees of SpaceX to sign on to this letter, asking leadership there to denounce Musk's behavior, or at least try to separate his behavior from SpaceX's own mission. But now those employees have been let go. And, there was obviously he spoke with members of Twitter, employees at Twitter yesterday, kind of going over everything that he plans, or most of what he plans for the company if he buys it, though he didn't say specifically that he still wants to buy it during that conversation. And so, now there's worries in Twitter, obviously, about how their activism will mesh with Elon Musk's management style and whether or not they would then face consequences for their own activism at Twitter.
Okay, so from what we're hearing in this report about SpaceX, from what we know in terms of the internal culture and the settlement that took place for racial discrimination at Tesla, for all of these question marks around how Elon Musk or the culture underneath of some of his companies is run, I think it's a fair question to ask. Is the profile himself still enough as a talent acquisition pool if enough employees are saying we disagree with how these companies are being run?
Yeah, it's interesting because there are a number of people, obviously, online, Twitter specifically, who, watch what Elon Musk says with bated breath, right? They'll follow him regardless of what he says, because of what he says. And there are probably a good number of talented people in those ranks, but you have to imagine that perhaps not many, it's not a majority of people who see what he says and think, yeah, he's right on everything, or, he should have this kind of free reign over Twitter, or, have free speech absolutism for Twitter, which is what he says he believes, and then kind of stifle the speech of people at his other companies in this kind of way. So, it's hard to determine whether or not it'll start impacting the business itself. The big thing that everybody looks at is Tesla and how that will be impacted by his behavior. And look, I mean, the guy sent out a tweet saying, funding secured, 420, smoked weed on a podcast. I mean, he does all these things, and Tesla's still, outside of the slump caused by the overall market and economic activity in general. The stock is still doing incredibly well. So people are buying Teslas left and right. I mean, I don't know if it'll ever impact the companies themselves or the people who would work there. I think, at this point, I don't know what kind of issue he could do or cause that would make people take a step back.
All right, Yahoo Finance's own Dan Halley. We'll continue to track this report as well as what comes next in kind of the world of Elon Musk at this point as well. Switching gears here, we got to talk retail on the day. Retail is under pressure after seeing a steep reversal in May, with record inflation causing a pullback for consumers, in turn producing higher inventories for companies. Joining us now to discuss the outlook for retail is Bernstein senior analyst Anisha Sherman. Anisha, great to have you here with us. Help us break this down a little bit, especially given some of the retail readings that we've been tracking. What does this shape up for the current quarter that we're in and the results that are set to start rolling in over the summer as well?
Yeah, it's been a bit of a mystery this year because overall the numbers show growth. So the apparel retail sector grew high single digits in March, high single digits in April, and high single digits even in May. And the March-April data was on top of triple-digit growth last year. So at a top-down level, it looks great, right? But there is a bifurcation in there, and we're seeing the more discounted concepts being hit much harder. And we've seen the results from Target and Off-Price talking about the low-income consumer pulling back. But at the same time, if we talk to companies like Tapestry that owns the Coach brand or Lululemon that target the 100K plus affluent consumer, their demand remains robust. So we're seeing that bifurcation, and I think we're going to continue to see that in the current quarter. I think the question is, if we continue to see high inflation and if unemployment starts picking up, then does that bifurcation blend? And so do we start seeing a pullback at more middle income and slightly higher income points, at which point it starts to impact the broader sector and not just the value players?
Anisha, are there companies in your coverage universe that you think are not well prepared to withstand a recession?
Yeah, so in my coverage universe, there's some recession-resistant companies like, off-pricers I think will do well in a recession. But I think some of the discretionary brands, so, even the bigger brands like someone like a Lululemon or someone like a Nike, if there is a large-scale recession that affects the middle income and kind of across-the-board consumers, they will take a little bit of a hit. But I think what we see in recessions is that big brands and big retail concepts tend to consolidate share. And so I think the bigger players are more defensive. The bigger risks to me are the small and medium sized, both in retail and in terms of brands, because they will lose disproportionate amounts of share and they don't have the operating leverage or the cash balance to get through negative sales numbers without having to close stores and make other more drastic cuts.
Has the pricing power that these companies exhibited within their most recent growth phase, has that evaporated?
So far, not at all. So on the higher end, all of the brands and retailers almost are taking price up. So we're seeing that from luxury downward into premium, downward into mainstream. Everybody is talking about price raises. They're doing it under the umbrella of kind of the whole industry taking price. And with inflation going up, that's a good way to pass on the cost to the consumer without the consumer pushing back. Even at the low end, we're seeing some retailers able to take price. TJX is a good example of this, where they've been able to take price on their more higher end assortment that targets the more affluent consumer. So if that affluent consumer starts looking a little less healthy financially in the next few months, then that outlook will change completely. But so far, pricing power has held up.
How do you explain the strength? You mentioned Tapestry. Is that a function of folks traveling again and going back to the office?
Yes, absolutely. So, this trade-off that we hear about between things and experiences, that does not apply to apparel and accessories. Apparel and accessories is driven by experiences and occasions. If you're going to a wedding, if you're going on a trip, you're going to buy an outfit and shoes and a handbag to go with that. So the huge surge in travel that we're seeing and in occasions and even going back to work has led to a surge in buying, which helps Tapestry. They sell handbags. It also helps the shoe and apparel brands.
Nike's an international company. Adidas is an international company. Lululemon, international company. How much is an impending recession, not just in the U.S., but even internationally as well? How much is that a headwind risk that they need to account for right now?
That's a great question. I think actually the risks are going to be staggered. So at the moment, all of the companies you named are suffering huge declines in China, right? Because that market is locked down. But as we're going to see China coming back, as we're going to see that spend surging, some pent-up demand unleashing towards the back half of the year, we may see more pressure in North America. So I think that being international, particularly having exposure to China and Asia, is going to be defensive over the next year because the impacts are going to be staggered between North America and East Asia.
Anisha Sherman, Bernstein Senior Analyst, always good to see you. Have a great weekend.
Thank you.
Demand is on the rise for in-person dining despite rising inflation, with a new Yelp report showing a reversal for the restaurant industry. Yahoo Finance's Alexandra Canal joins us now with the details. Alex.
Hi, guys. Yeah, so Yelp is out with their State of the Restaurant Industry report, and there's some interesting little tidbits in there. According to the report, more than 13 million diners were seated via Yelp during Q1 2022. That's a rise of 48% compared to the year-ago quarter. Now, reviews did mention obvious staffing shortages, longer wait times, along with those higher menu prices, which, by the way, jumped 7.4% during the month of May, according to the latest CPI print. But despite all of that, consumers, although they're aware of inflation, they're actually wanting to spend money on more higher end, upscale experiences. So I guess they figured if prices are up everywhere, we might as well go big or go home. Why not? So we're seeing that on the rise, in addition to takeout on the rise too. Although that did dip slightly on a year-over-year basis, we are still seeing numbers up compared to 2020 and 2019. So those numbers, by the way, should be up 107% increase and 144% increase. So that shows that that could possibly be another pandemic era trend that will continue.
Yelp also noticed an uptick in experience dining here. So break this down for us. Like, what exact experiences are consumers gravitating to in this climate?
The fun stuff, Brad.
Okay,
So
all right,
think
cool.
conveyor sushi, think dinner theater. Yes, dinner theater,
going near that.
supper
I'm not
clubs,
going-
internet
You
cafes.
just stand at the end of the bell.
Yes.
Just open
You
your
know,
mouth.
I've been to
Cartoon
dinners.
style.
I have been to dinners though where you sing and you dance, and I think that's fun. I think it relates to the fact that people were stuck inside for 2 years during the pandemic. Yes, there's inflation, but they want to get out there. They want to have fun. They want to experience different types of things, different types of dining experiences. You're seeing there all the different options that are available to people. So I think this just speaks to the fact people want to spend more on experiences, and there you have it.
You would appreciate this. I paid $24 for a Chipotle bowl this week, having it delivered. If I'm going to pay this, I'm going back to
Because you had it delivered.
I want to get this experience. I want to smell burritos. I want to smell beans.
Exactly, and that's why I also think takeout is actually going to be more popular, because for me, anecdotally, I'm not going to spend $10 to $20 more to get it delivered. I'd rather drive or walk and just pick it up at the window, because the fees are insane, and it's only compounded by inflation.
How do you think this is impacting? You know, we've seen menu prices go up through the roof, but I wonder how the likes of a Darden are starting to feel this impact here as well.
Yeah, and they report earnings next week, so I'm sure that we're going to get a little bit of an update on that. I think it is reassuring that in-person dining is returning, and also there's a ton of demand for both outdoor and indoor, which is interesting. I guess people are more comfortable with the pandemic at this point. So I do wonder how that will impact Darden's bottom line.
It just costs you $20 to actually drive to an Olive Garden.
Right.
10 miles away, $6 a gallon. Yeah.
Right. By the time you've already factored in the delivery cost. At that point.
It's crazy. It's crazy out there right now.
Two things really quickly on this conversation, though. On what head count are they going to see this kind of interest continue to tick higher? And then additionally, I mean, operationally, they are looking at different days that they're even, like one of my favorite spots in Bushwick, I'll shout them out, Forest Point. I'm there all the time. And they have refined the number of hours and days that they are actually operating. And so many restaurants have already done this, in addition to adding on the delivery options and so forth. So what does the realistic equation look like for them? What type of staffing are they going to need necessary in order to give the people the experience that they want when they're coming out of kind of the work from home, everything from home hibernation?
Staffing is certainly probably the biggest issue that all restaurants are facing. So they're having to get a little bit creative to bring in different types of revenue. Ghost kitchens actually becoming very popular. Yelp added a feature in September that you could label your business as virtual. Since they did that, 3,000 businesses have said that they have ghost kitchen operations. So that has helped alleviate some of that staffing pressure, but that is certainly an issue that's going to have to be addressed. You need to potentially do benefits, higher pay. How do you get people to work when no one really seems to want these jobs right now? And that's going to continue to be a challenge for them.
There better be people at my local Wendy's, because I'm ordering Wendy's today. I just decided right now.
Oh, a Frosty?
I'm
Let's
getting
do
a Wendy's.
He's a Baconator fan.
I'm getting
He's
3 chicken
definitely-
sandwiches.
And a Frosty. Add a Frosty
and
to my list.
All right. Stick around, Allie, because we've got much more. Guys, coming up, Watch the Throne. Jon Snow is coming back, but do fans want it? The Game of Thrones spin-off news that has the internet in a frenzy. That's up next. Welcome back to Yahoo Finance Live, everyone. We want to turn now to the stories that we cut for time here. 3 headlines influencing markets in one way or the other, all delivered in 3 minutes. Starting with Allie, what are you watching?
So Kit Harington, a.k.a. Jon Snow, he is reprising his role for a new Game of Thrones sequel. Now, this sequel is going to take place immediately after the events of Game of Thrones. So many people thought this was going to be an ironclad ending, but I guess that's not the case. I do love when sequels bring back original characters. I think it keeps the integrity of the show. And it also means that we could potentially see some other characters pop up for Game of Thrones. I don't know if you guys are fans of this series. Okay, great.
I am a fan.
So I am going to get trolled. I'm going to get trolled for this. I watched the final season because I wanted to be a part of the water cooler conversation, but I did not watch anything
I knew where this was going.
That's good.
Now,
That's a life hack.
I was basically bugging my roommate the whole time, being like, okay, so I had literally a note by like, who's this? What's that? She goes, I'm going to kill you. I wanted to enjoy this final season, and you ruined it for me.
My word. Okay,
I know.
I'm a fan, and I'm not even looking forward to this.
It's a lot of effort, though.
Like, why can't we just leave some things? Like,
Yes.
just have it be done. We don't need a reboot
There's
of it. We don't need
prequels. There's multiple
prequel, the
prequels in the works,
sequels.
too.
Yeah, we're on Jurassic Park 17
Oh,
by this
and the
point,
last
so-
one is the worst reviewed in the franchise.
Yeah.
So I don't
This is a
know.
good thing. It's coming at a good time for Discovery, post merger and acquisition. Good for them.
Yes.
Jon Snow, moving markets. There we go.
As for me, energy woes mean higher gas prices, but the rising cost of diesel also leading to increased prices. And I got to give a shout out to our very own Ken Underwood. He's on the other side of the camera today, working very hard for us. You know, he reminded me of that shock when you go to the gas station, you walk up there and you see $6.50, and you realize, wow, that's my gas price right now? No, it's actually diesel prices. And that was my take or reaction last week when I would fill up my car. And diesel prices were actually $6.40, and diesel prices across the country have gone through the roof. Now at $5.72 a gallon, up 75% year over year. Now, that has major ramifications for, of course, the economy. Truck drivers, people that drive large SUVs. I've seen TikToks and people cost to fill up an average truck $150 right now. It's just amazing.
It trickles down to the consumer too.
Absolutely,
though.
yeah.
Because when companies talk about this being factored into the price that you are paying, this is exactly what they're talking about. How much operational expenses the truckers are taking on, and thus us, in order to get that product. And for even those that are opting up to freight, they might be opting up to freight or air freight as well. And we're still going to see all those costs at the end of the day.
And truckers are the backbone of the American economy, right?
Yeah,
like that's how we get our Amazon packages, our groceries, our furniture. It's crazy to think about this ripple effect. And it's really going to impact these smaller truckers too, and those smaller fleets. So I think it's really devastating.
I'm really happy I do not drive a Mercedes diesel.
No, yeah, I 100% agree with you.
I know you're a Mercedes fan, though.
I am a Mercedes fan. Newfound respect for, well, of course, always a respect for truckers who navigated throughout this entire pandemic in more ways than one. My grandfather was a truck driver. They do a ton of great work out there on the roads. All right, guys. Also, we got to talk about Instagram, the IG, testing out a new layout that actually brings Compose back to the center of the navigation bar. Thank goodness. That place currently occupied by access to its TikTok competitor, Reels. Now, the changes also include a new full screen feed similar to TikTok. All right, so we're taking a look at, I think, some of the changes that are going to be taking place here. But I don't know if you guys are even on TikTok all like that, but I don't know if I'm ready for yet another change. I
was just about to say that. Can we stop updating Instagram?
Right.
I'm over it.
Done.
The layouts, it's confusing. They seem to do it and people complain.
Yeah.
What is the reason?
I just want a simpler Instagram.
Yes.
Maybe it's me now being a middle-aged male. Whatever it is, I need.
It's not user-friendly.
I need something easier to use. I can't keep track of all this stuff, and I'm still trying to figure out how to make a great TikTok. Man,
I don't think I've ever made a reel. I have made 2 TikToks before, and that's.
I haven't made a reel either, but I'm curious.
Yeah.
Just
I
make
want
it.
to do
Just
it.
make it easier for us. Not easier for you to make more money there, Meta. Please make it easier for us.
It's hard to even do a boomerang story, let alone make a reel. I'm like, where's the boomerang button? I can't figure it out. I'm over the updates and the layouts.
Oh man, we really
Too much.
We really sound like geriatric millennials here today.
Giving away our age.
All right, let's leave it there. Let's on that high note, let's get a quick check of the markets here on what has been a wild week for investors. Seeing the markets, you're seeing the Dow now down about 100 points. Again, this whole session was set in motion here by Fed Chief Jerome Powell saying the Fed is acutely focused on fighting inflation. You're seeing the Dow down now 112 points, the S&P 500, NASDAQ, a little more mixed action. That's it from us here on Yahoo Finance Live. We'll be back at 3 o'clock with more markets coverage. Have a great weekend.
Stocks. Tech stocks are continuing to get battered amid the broader market sell-off, with tech giants like Meta, Alphabet, and Netflix all down significantly year to date. Cowen's senior analyst John Blackledge joins us now to discuss here. And we had seen some of these tech stocks moving in lockstep, particularly with what the Fed was signaling. And so now that the Fed has made their decision yesterday and kind of telegraphed what the pathway forward may look like, how do you expect tech to continue to react from here?
Yeah, I know, and thanks for having me on. We had a couple notes. It's interesting, we had a couple notes out this morning on Alphabet and Meta. We did just mid-quarter ad checks, right? With all the macro headwinds, rates and inflation, geopolitical, we're just curious. We checked with our agency that we use, our digital ad agency, to see what, where we were for Meta and Alphabet 2Q to date through May. It was interesting for Meta. Our agency saw ad spend down about 4% through May. We have for the full quarter plus 2%. So it's tracking below where we are for the full quarter. But remember last year, the iOS 14.5 changes started in 2Q21, so the comps actually get easier for Meta as we get through the quarter. So probably our numbers probably still okay. On the go forward, it's a bigger question, and the question would be about ad demand with the rising rates and all the macro headwinds, and we'll try to examine that as we get through the back half of this year and into next year. And then for Google search, our agency check was 18% growth. Through May, we're at 16% for the full quarter. So, kind of tracking relatively in line with where we are. And it's a little bit of a decel from the first quarter growth rate. So, it seemed despite everything that's going on, the numbers for the two companies seem to be the near term numbers seem to be tracking kind of where we are.
Hey, John, it's Julie here. Is there, though, when you're looking at that ad spend, is there a direct correlation between higher rates and a slowdown in ad spend? I mean, and a direct correlation through several layers, right? If higher rates are affecting, consumer spending on the margin, and then that affects these corporations, and then that affects what they're spending on ads. Do you expect to see a more severe feed through as rates continue to move up?
Yeah, there historically for advertising, there's a direct correlation with GDP growth. So to the extent that the higher rates lead to, kind of slowing GDP or declines, people are calling for a recession at some point, maybe back half of this year and the next year. And so if you look at, I think the thing that matters is what is earnings next year for these companies. Are the rising rates and the macro headwinds, are they factored into stock prices right now? If you look at, just take Alphabet in the 08-09 recession, they obviously see the demand dwindling during that time period, and they put the brakes on cost growth. In 09, their cost growth was 0%, and their earnings were kind of in line with 08 levels. And as 08 was getting into 09, you saw the cost growth slowing down and then just flat in 09. So I think, for these companies, and you also saw in 2020, when COVID hit, both Alphabet and Facebook wasn't public in the 08 recession, their cost growth really, they put the brakes on costs. So that's what we're kind of going to be looking for. And they're going to see slower demand before any of us see it. And then I think they'll act on that. And even for Meta, they're losing a lot with their metaverse investments. And you're seeing reports since they reported 1Q that, kind of they're slowing hiring. So we'll have to see. But in the near term, it looks like things are kind of where we think they should be, but obviously there's interest rates and all of the headwinds are clearly going to be around for a bit, and so we'll try to do the best we can to forecast, kind of through the year and into next year.
John, how bad does it get for Netflix in a recession?
It's interesting. We did a ton of work on their potential ad business. That we published that yesterday, and I would say what's interesting is we think they're going to introduce an ad tier. Our work, and we do a lot of survey work, monthly proprietary survey work at Cowen, and our work suggested that if they introduce a new lower price ad tier, they could add up to 4 million new members in 2023. And we think they're going to introduce the ad tier sometime late this year, fourth quarter. And so 18% of people, of non-member respondents, said that they were either extremely likely or somewhat likely to sign up for a new lower priced ad tier. What does that mean? Well, it means from a revenue perspective, we get to about $900 million in incremental revenue from those members. And how, what does that look like? Well, we get to about $17 in revenue per member per month for a new ad tier, and that's broken into a $6.99 subscription fee, which is kind of around where other premium streaming platforms are. It's also 30% below Netflix's basic tier, which is its lowest price tier. And then we got to about $10 a month on the ad side. But to the question, if they offer a new ad tier, it's going to be cheaper, either for new members or if existing members want to switch. For instance, we also asked the question to existing members, would you switch to a lower price ad tier? And 41% said that they would switch. And you guys
together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back 'cause I'm gonna be a lonely girl again. Come back 'cause I'm gonna be a lonely girl. could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up, a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. give up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. up, a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. that I could write down what you mean to me.